Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to talk about 10 stocks that I'm buying in 2023. Pretty much everybody from CEOs of companies to so-called professionals at Wall Street and social media influencers are calling for a recession in 2023 and talk about doom and gloom. I cannot predict the future, and therefore I don't know if a recession is coming in 2023 or not. But whatever happens in economy, if the share price of these companies that I talk about today remains the same or drops even more, I will be a buyer of these stocks in the new year. I think a good investor should not focus on macroeconomic events and market news that much, despite what mainstream media is trying to tell you. I love Peter Lynch quotes and his investing philosophies. He mentioned a great quote about looking at macroeconomic indicators for investing. This is the quote: I think if you spent over 13 minutes a year on economics, you've wasted over 10 minutes. And I agree with that. Instead of wasting my time on trying to predict what Fed or Bank of Canada is going to do, or what is the inflation number next month, or what analysts are predicting for job losses next month, I will focus on fundamentals of each company, each business, each stock, and try to buy the best quality stocks under their fair market price, their fair market value. This is in line with another Peter Lynch quote, which I basically show it here. Stocks aren't lottery tickets. Behind every stock is a company. If the company does well, over time the stock do well, and vice versa. You have to look at the company. That's what you research. Okay, with that being said, let's look at the 10 companies, 10 stocks that I've done my research on them, and I will buy their stocks in 2023. Note that I already own 6 of these companies in my portfolio, and 4 of them are new companies for me. The first stock that I will buy in 2023 is Brookfield Corporation. Brookfield is a behemoth of the company with multiple income generating streams from asset management to renewable energy and real estate. They are somehow similar to Berkshire Hathaway in the sense that they are trying to find undervalued assets and businesses and buy them for cheap prices. However, the Brookfield recent decision to spin off the asset management business as a separate company left investors confused with the valuations, and confusion always leads to sell-off. The shares of Brookfield Corporation currently trades around $43 per share, and my fair value estimate based on discounted future earnings model tell me that it should be around $53 per share for a 10% return year over year, which means Brookfield Corporation shares are trading at 27% discount at the moment. They pay a dividend with a starting yield of almost 1.5%, and the current price to earning of 15 and price to cash flow of 6.3 are lower than the 5-year average and historical values. Brookfield has a huge cash position ready to deploy in undervalued assets around the world during this potential upcoming recession, and Brookfield revenue is estimated to grow around 20% year over year in the next 5 years, and therefore I think they are in a great position to generate value for investors in the next couple of years. I will release a video in the next few days about my take on Brookfield spin-off and why I basically buy Brookfield Corporation instead of the Brookfield Asset Management company. But here I just want to mention that not only I will hold my current shares in Brookfield Corporation, but also I will continue to buy this stock in 2023 as I think it is severely undervalued here. The second stock that I will buy in 2023 is Google or Alphabet. I believe Google has an amazing risk-reward profile at this point. It is a great business. Google has huge moat in AI. It has the largest amount of data from users in the world through their search engine and YouTube, which is a valuable asset for the company. They are still growing their cloud business, and their valuation is a screaming buy at this point for me. All the valuation and quality metrics of Google says that it is undervalued at the moment. Its price to earnings of 17 and price to cash flow of 12.6 are significantly lower than its 5-year average values. Its PEG ratio is close to 1. The return on invested capital remained strong at 23.6% in the last year, even stronger than the last 5-year average. And my calculation and estimation based on discounted future earnings model tells me that the fair value of Google stock for a 10% return year over year in the next 10 years should be around $113 per share. So the shares of Google today are trading at 28% discount according to my estimates. I already have a large position in Google and will continue to buy more shares of Google in 2023. The third stock that I will buy in 2023 is Canadian Tire. Canadian Tire store itself is a Canadian version of Home Depot and is my favorite place to buy home improvement equipment and DIY tools. In addition, the company offers auto services and also own other retail stores like Mark's, Atmosphere, Party City, Sport Check, and Canadian Tire gas stations. They also own a few brands like Helly Hansen and MasterChef, and also they have their own financial segment via Triangle MasterCard and Triangle Reward programs. I will release a detailed stock analysis video on Canadian Tire in the next couple of weeks and discuss the details of each segment of their business. The shares of Canadian Tire currently trades at $140 per share, and my fair value estimate based on discounted future earnings model tells me that it should be around $164 per share, which means Canadian Tire shares are trading at a 17% discount today. They pay a huge dividend with a starting yield of almost 4.8%, and their current price to earning of 8.3 is significantly lower than its 5-year average of 12.8. I have a small position in Canadian Tire already and will continue to buy Canadian Tire in 2023 and try to make this a full position this year. The next company that I will buy its shares in 2023 is Meta Platforms. I talked about Meta a lot. I believe this stock is massively undervalued at the moment. They own 4 of the most successful social media platforms and messaging apps on the planet: Facebook, Facebook Messenger, Instagram, and WhatsApp, with almost 50% of the world population already subscribed to at least one of these platforms. I like their Oculus VR headsets, and they are also investing in metaverse concept, which I'm not really sure if it would be a success for the company. The current price to earning and price to cash flow are both significantly lower than the market average and historical average numbers for Meta. Even considering a complete failure in metaverse investments, I think Meta is undervalued with a fair price around $220 for a 15% return year over year in the next 10 years. I already own a large stake in Meta, and I will continue to buy Meta in 2023. The next company that I will buy its shares in 2023 is Alimentation Couche-Tard. Couche-Tard is a Canadian company based in Quebec, which owns numerous gas stations and convenience stores around the world, in Canada, US, Europe, and Asia. I recently reviewed this business in detail, and my conclusion was that the fair value for Couche-Tard for 10% return year over year in the next 10 years is close to $63 per share, which means Couche-Tard stock is undervalued by almost 6%, considering the current share price of the stock is around 59.5. They pay a dividend with a starting yield of 0.9%, and their current price to earning and price to sales are slightly lower than their 5-year average. I already have a very tiny position in Couche-Tard, and I will try to continue to buy this stock in 2023 and make it a full position in my portfolio. The next company that I will like to buy its shares in 2023 is MasterCard. I don't own any MasterCard shares at the moment, and this is one of the companies that I'm closely watching at this point. I really like to own this stock as I believe MasterCard has a rock solid balance sheet and business model with huge moat and a still large growth potential. They have excellent margins. The return on invested capital is almost at 50%, which means this is an extremely high quality business. I think they have better management and better partnerships comparing to Visa and Amex, and they are a safe investment with compounding potential for several decades. The shares of MasterCard currently trades at $347 per share, and my fair value estimate based on discounted future earnings model tell me that it should be around $405 per share for a 10% return year over year in the next 10 years. So MasterCard shares are trading at a 16% discount today. They pay a dividend with a starting yield of 0.65%, and the current price to earning and price to cash flow of 34 and 30 are lower than their 5-year average of 43 and 39. I understand their PE ratio is still rich, but this is an amazing business, and sometimes you have to pay a premium to own such a great company. If MasterCard share price remains the same or drops even more, I will be a buyer of this stock in 2023. The next company that I will buy its shares in 2023 is Killam Apartment REIT. I already have a small position in Killam, and I believe this is one of the best real estate investment trusts in the market. They have the majority of their apartment buildings in Atlantic region of Canada, where the price of real estate and land increased exponentially in the last couple of years with a faster growth rate than even Ontario. They have a high quality portfolio of relatively new condos and apartment buildings which require less maintenance in the future. They have almost 100% rent collection per month. They have a reasonable payout ratio at 74% of their adjusted FFO, which leaves them with plenty of room to reinvest in themselves and grow in the future. And they demonstrated a history of reasonable growth in their funds from operation per share every single year by more than 5%. The shares of Killam currently trades at around 16.2 Canadian dollar per share, and my fair value estimate based on discounted future funds from operation model tells me that it should be around $19.5 per share for a 10% return year over year, which means Killam REIT shares currently are trading at a 20% discount. They pay a dividend or distribution with a starting yield of 4.3%, and their current price to FFO of 17 is lower than the 5-year average of 21. So I will be a buyer of Killam Apartment REIT shares in 2023. The next company that I will buy its shares in 2023 is Amazon. Owning Amazon is like buying into an ETF, as they basically expose you to various income streams of the company. Amazon, much like Google, Brookfield, Tencent, and Alibaba, is a spawner. And by that I mean they use their main business profits to invest in new and risky projects that can be independent and new sources of income in the future. Amazon balance sheets may not show the best cash flow and EPS numbers, as they heavily invest capital into their own business to grow even faster. They have a massive e-commerce platform with Amazon.com and Amazon.ca, a massive cloud business with AWS, an entertainment segment with Prime Video and music, plus Twitch for gamers and streaming video games, a robotics segment, a software segment with a focus on Alexa, a home security segment with a focus on Ring product lines, and they have their advertisement segment, which is growing fast. The shares of Amazon currently trade at $84 per share. Modeling the future cash flow of Amazon is extremely difficult due to the nature of their business model. But my fair value estimate, based on some assumptions about the profitability of the company in the future and using discounted future cash flow model, tells me that it should be around $88 per share for a 15% return year over year, and a 15% is there to give me more margin of safety because of the uncertainty in Amazon profit margins in the long term. So the current share price is at a discount to my estimated fair value, and that's why I will be a buyer of Amazon in 2023. The next company that I like to buy its shares in 2023 is Canadian Pacific Railway. This is one of the recession-resistant companies with an extremely large moat and oligopoly with great potential to eat even a larger market share in future due to their control over Mexico, US, and Canada railway route, which is unique for a company. The reason I said I like to buy this stock and not I will buy this stock is that this is the only company in this list that I think is still expensive. But I realize that sometimes you have to pay a premium to own such a great business like Canadian Pacific. The shares of Canadian Pacific Railway currently trades at $100 per share, and my fair value estimate based on discounted future earnings model tells me that it should be around $66 per share for a 10% return year over year, which means the shares of Canadian Pacific is trading at a very high premium today. I don't want to pay this much premium for Canadian Pacific, but if the shares drops to 80s, for example to $84, $83, then I will start a position in this company. They pay a dividend with a starting yield of 0.75%, and the current price to earning and price to cash flow are significantly higher than the 5-year average. If Canadian Pacific share price drops in 2023 to low 80s, I will be a buyer of this stock, and if not, I will just pass and invest my money in other companies. The last company that I want to buy in 2023 is Taiwan Semiconductor. This is one of the most important companies in the world which manufacture the semiconductor chips necessary to use in various industries, including most of the electronic devices that we use every single day. Companies like AMD and Nvidia, which most of the investors consider them as high quality semiconductor plays, are actually customers of Taiwan Semiconductors. This is the company that Warren Buffett and Berkshire Hathaway recently started a position in. Despite their clear plans for building a new chip fabrication facility in US, of course the geopolitical risk of locating in Taiwan so close to China will always be a hang over this stock. That is the reason that this stock is trading and has been trading at such a low price to earning despite their incredible moat. The shares of TSM currently trades at $74 per share, and my fair value estimate based on discounted future cash flow model tells me that it should be around the exact value for a 15% return year over year, which means TSM shares are trading at its fair value today. The 15% expected return is there to make sure I have enough margin of safety to buy this stock, as geopolitical risk is always there for this company. They pay a dividend with a starting yield of 2.4%, and their current price to earning and price to cash flow of 13.4 and 7.9 are significantly lower than their 5-year average of 23.4 and 13.9, respectively. I will be a buyer of TSM shares in 2023 if the share price remains the same or drops even more. There you are, guys. I hope you enjoyed the video, and if you liked the video, consider subscribing to the channel to see similar videos. Happy New Year, thank you for watching, and I hope to see you guys in the next video. Farewell.